All right, good morning, everyone. Today is Thursday, October 22nd, and welcome back. It feels like a reunion. Where have you people been? Anyway, we have a quiz today. Maybe that explains the attendance, but I know, it's just a guess. So today I'm going to continue on Chapter 3, which will be covered on the midterm next week, which is, it's a week from today, I think, the midterm, right? And I sent you an email the other day that sort of lays out the ground rules for quizzes and exams, okay? For the midterm, I'm going to ask you to leave your backpacks at the end of the aisle. It's fine today for the quiz. And for the midterm, you know, there's no lecture that day, so just bring your pens or your pencil and your calculator, and the backpack's always at the end. And try to space yourselves out, too. I know we're not totally full here, but if there's room, that's good to space yourself out. All right, Chapter 3, we're talking about intertemporal price relationships, which would be price spreads. We talked about futures curves that show on a given day prices of futures contracts for different expiry months. So that's what we talk about when we talk about intertemporal price spreads. And yesterday, Tuesday, we introduced a few terms that are important in this regard. One was Contango, and one was backwardation. Contango is an upward sloping futures curve, and I drew a picture of that on Tuesday for the corn market, where the spot price is $3.50, the next futures is $3.55, and then $3.60, $3.65, and so on. Futures curve is upward sloping. That's a normal price relationship. When we see that price relationship, the market is signaling that there's adequate supply. Some traders will even view that as a weak market, which means that there's no suggestion that prices are going to rise. When you have an inverted market or backwardation, that's where the forward curve is downward sloping, and I drew a picture of that on Tuesday from the sugar market. When you have an inverted market, then the market isn't paying for storage. In a contango, you can view the price spread between the spot and the futures, or two different futures, as a price of storage, because you can buy one and sell the other and carry the commodity forward. And you can lock in that return for storage. In an inverted market, the distant price is below the nearby. So if you purchase the nearby and sell the distant, you're going to lock in a negative return for storage. So the market's telling you not to store. In other words, it's a strong market, suggesting that there's inadequate supply. And that's what we're seeing in the sugar market today. And if you think of the contango, you think of that upward sloping forward curve, just how steep can that curve become? Do you suppose that nearby oil is $45 a barrel? The price of oil a year from now is just over 50, I think. Spread's $5 or $6, maybe $7. Do you suppose that curve could steepen so that spread would be $30 a barrel? Does anyone think that's a possibility? Or we'd have a contango, and so in the price of oil, the price today is 45, and let's say we look at DES 16, do you think that price could be 75? So we have a very steep curve. Does anyone think that's a possibility? Paul? Yeah. You do? Okay. If it was, thank you. At least one person out of 140 was brave enough to answer. why don't you help me out? Why do you think that's a possibility? Certainly possible it's going to be upward sloping. We know that.
To be honest, my understanding of Contango, and that's not a complicated topic, it's like not perfect, but I just
Okay.
think that the oil could fluctuate that much or be predicted to fluctuate that much.
Okay. So you think it could reach 75 next year, therefore you could see that sort of contango. However, Paul, if that spread was $30, I think you and I better go out and buy some storage facilities and store oil because the storage costs are not going to be $30. Okay? So the price today is $45. It's not going to cost us $30 to store that oil for a year. I would say the maximum cost is probably, $8 or $9. So why? Good question. Why is the maximum cost $8 or $9? Well, what do you have when you have storage costs? You have physical costs of storage. So we'd go out and buy a big tank. So we'd have the physical cost of storage, or maybe we could rent it, right? And then we would have some insurance. And then if we buy the oil and put it in the tank, which I'm suggesting we do, if we see this, then we have the interest cost, the opportunity cost of our money that we use to buy the oil to put in the tank. So those are the main costs of storage. Right? So you add those up, and there's going to be some upper limit. And just for sake of argument, let's say it's $10 in this case. So if it's $10, then that's the maximum spread that you would see. So the forward curve would look like this. And if it's got steeper, if it became steeper, then I guarantee entrepreneurs, merchants, would buy the 45, they'd buy the nearby and sell the distant because they can guarantee themselves a rate of return. So if it was 45, 55, you could guarantee yourself $10, which would be full costs. So we would do that. If it was 30, we would do it over and over again until that spread comes down. And this is called arbitrage. You're arbitraging the nearby and the distant. And if you have enough participants in the market buying the 45 and selling the 75, that spread's going to come back. So there is an upper limit to the contango, which would be full storage costs. Does that make sense, Paul? Yeah.
So would even a spread of $10 bring enough arbitrage that the contango would go away, or would it still be there?
The contango wouldn't go away. It wouldn't drive it away, but it would bring it down. What I'm trying to say is there's a maximum cost of storage. Okay, we all agree on that. And it's going to vary from firm to firm depending on your facility, depending on your cost of money. So your cost of storage might be different than mine, but there is some upper limit. And let's say it's $10 in this case. Okay? So you wouldn't see the market, the contango, being more than $10 for any length of time, because maybe my cost of storage are only 7 or 8 years or 10. So I'm going to arbitrage anything over 7 or 8. It's going to pull it back.
Because any profit you would make would really just be going into your storage costs.
Yeah, it'd be a storage return, pay for your facility. Yeah, okay. So when we see contango, we know that there is an upper limit on the steepness. So the question is, would the storage costs in one area be equal to the transport costs of moving it to that area? No, I'm keeping those two costs separately. So if we're talking about oil, Yusuf, the delivery point is in Cushing, Oklahoma. So yeah, there's some costs of transporting oil from North Dakota to Oklahoma, but that's really a separate issue. What we're talking about when we look at a forward curve, or futures curve, I should say, is we're looking at two prices for the same commodity in the same location. Everything is the same except the date. So it's the same location. We're holding it constant. So there's no transportation costs involved. Okay? So this would be the price of oil in Cushing, Oklahoma in December 15, and the price of oil in Cushing, Oklahoma in December 16. Will the price in D16 be higher than D15? Yes. Not always. Sometimes we have an inverted market. But certainly that's the case now. So there's an upper limit to the contango. If you have an inverted market, and I think in the case of sugar, we said the market was inverted, and maybe the nearby price is 14 cents, and the more distant price is 12 cents. So then we have a downward sloping futures curve. Arbitrage doesn't work as nicely in this case, because in the case of oil on the left-hand side, you can buy the 45 and sell the 75, put it in inventory, and then deliver on the distant. But if this is the nearby 14 cents and this is the distant, well, you can't bring sugar from here to here, can you? Because this might be D16 and this is D15. We can carry sugar from December 15 to December 16, but we can't carry sugar from December 16 to 15. There's going to be harvest in between. So when we look at an inverted market, which we said is a signal that there's inadequate supply, the steepness of that futures curve is indeterminate. In other words, we could have a very steep inversion and there's no corrective mechanism. Like Paul, who's going to go to work in the oil market, there's no corrective mechanism to limit the size of that inversion. In other words, this could be 14 and 12, or if there was a disaster in the sugar harvest down in Brazil, this could go to 6 cents. So you could get a very, very steep, and that might pull up the nearby price as well. So just keep that in mind when we're looking at contango versus inverted markets. There's a limit here, and there's no limit here. Okay. Any questions on that? All right, chapter 3 talks about two sort of big ideas regarding intertemporal prices. And one big idea is the theory of normal backwardation. The other big idea is a theory of storage. It can be a little confusing because when we look at this relationship, we say that's backwardation, where the distant is below the nearby. The theory of normal backwardation is something different. It uses the same word, I know, and I can't correct that. I can't go back to the 1920s and correct it. I wish I could, right? Just like the sugar market. I can't bring sugar from the next harvest to now, to arbitrage. So there was a guy named John Maynard Keynes. Maybe you've heard of him. Very famous macroeconomist. And he loved trading the futures market. He used to get up very early every morning and was a renowned trader in commodity futures. And he had a theory about these intertemporal prices, right? So that's what we're talking about. We're talking about the price between December 15 sugar and December 16 sugar. We're talking about the price of December crude oil and June crude oil. These economists thought about these price relationships and came up with an explanation as to what sort of price relationship we should expect and what factors will change that price relationship. As I said, that price relationship is not constant over time. The sugar market, if we go back 6 months, didn't have this shape in the futures curve. If we go to the crude oil market, 6 months ago, the futures curve had a different shape. So these two theories are really talking about the shape of that curve. The theory of storage was pretty much developed by a guy by the name of Holbrook Working, an economist at Stanford, who came after Keynes. The theory of storage, which we'll talk about in a few minutes, focuses on the supply and demand for storage. That's what we're talking about in the case of crude oil. Paul was asking about the cost. Well, that would be the supply side, right? The marginal cost of storage will give us a supply curve. The demand for storage, well, that comes from the marketplace where the demand for storage reflects expectations regarding what's going to happen in the next period. Okay? We're going into the winter months now. We know that in the winter we use a lot of heating oil, especially in the northeast part of the country. So there's a demand for storage to carry heating oil from this time period into the winter months. And that demand curve is going to change depending on weather forecasts, okay, and other factors that may impinge on that market. It's going to partially depend on how much heating oil we expect to produce in the winter versus how much we're going to consume. So that's the theory of storage. The theory of normal backwardation, which is Keynes, he focused more on the balance between traders' positions, the balance between their positions. And I'll explain that in a second. Okay, this next slide has some intertemporal prices, but I'm going to skip that because instead I used an example last week from corn and sugar. So it's also true that in a given market, we might see part of the curve in contango and part of the curve in backwardation. In fact, if you look at the sugar market today, you'll see that front part of the curve is in backwardation and then it goes into contango later. If you look at crude oil, I think it's in contango as far as the eye can see. And a lot of this has to do with expectations regarding future supply and demand and also storage costs. So here's a picture of the wheat market. And this picture was taken on a given day. So when we talk about intertemporal prices, so far I've been talking about the set of prices for different delivery months on a given day. What did the sugar market look like on Tuesday? What did the corn market look like on Tuesday? What does the crude oil market look like today? And I'm talking about all that spectrum of prices. So here we have the wheat market over on the left-hand side. This would be the spot price. Let's say it's August. That would be the spot price. And then we have these futures prices. We have December futures price, which is $8.40. Spot price is $8. We have March futures, which is $8.65. And then we have July, which is $8.20. So you'll notice when we go and compare the spot price with December and March, that's in contango. Why is March higher than December? Why is December higher than August? Well, it's the wheat market. It's a storable commodity. Remember when I talked about the history of futures trading, how this institution developed? It had a lot to do with the marketing of wheat in the Midwest where everybody wanted to sell the wheat at the same time right after harvest. That depressed the price. There were inadequate storage facilities. So this market developed to remove that inefficiency. And part of the function of the market is to provide a return for storage. It is encouraging people like Paul to build storage facilities. So that's why we'll see this market in contango a lot of the time. And the storage costs are going to vary. We talked about the factors that play in storage costs. Right now, interest rates are really low. So storage costs, that part of the storage cost equation at least, is lower. You have your physical costs, you have your insurance. But if you look at this picture today, what the market's telling us is today's price is $8. The price in March is $8.65. So one way to view this is the market is projecting that the price is going to be higher in March than it is in August. That's not an unreasonable projection because it costs money to store wheat from August to March. And why would anybody store wheat unless there was a return from doing so? If there was no return from doing so, they would dump it now. So that's the snapshot today. Paul.
People who are storing the wheat, are those traders actually dealing with the commodity? They're not just buying the future contract for it?
So your question is, the people that are storing the wheat, are they actually trading in the market? Is that what you're asking me?
Because a lot of traders don't even deal with delivery.
Right. Everything I've said does not require delivery. So I'll try to answer your question. Okay, so your question is, do the various wheat traders actually trade futures? I think that's what you're asking me, right?
Yeah, I mean, most traders aren't responsible for storage of any commodity.
A lot of traders own no storage facilities. That's correct. But there are a lot of traders who do. So, in the wheat market, it's different than the oil market. In the wheat market, you have large commodity merchants. Have you ever heard of Cargill? Okay, Cargill is one of the largest privately held companies in the United States. And I'm proud of the fact that one of the senior executives in Cargill is a woman who took this class probably 20 years ago. And I still keep in touch with her. And she learned about commodity merchandising in this class. And Cargill is one of the largest, they're huge commodity merchants in the world. They have facilities in 100 different countries. They own a lot of storage facilities. They trade a lot of wheat. They trade a lot of wheat futures, and they own big storage facilities throughout the U.S., on the New Orleans, West Coast, various parts of the country. So that's a big part of their business, is earning a return on those facilities. And that's just one example, okay? Now, a farmer, they'll have small storage. A farmer will have small storage on their farm, relatively speaking, and they might not trade directly on the futures, but they could harvest their wheat and then go into the local Cargill elevator facility and say, I've got 20,000 bushels of wheat. What's your price if I deliver it in March? They've just harvested it. They put it in their storage bins. And Cargill will look at the Chicago market and say, well, you bring it in March, and we'll give you 50 cents over today's price. And you sign a forward contract. So then the farmer is getting a return for storing it, because they know if they hold it until March, they're going to get 50 cents above today's price. And they might be happy with that. Okay? So there are a lot of different participants that own storage facilities that are involved, and there's also traders who don't own storage facilities. Yeah.
Question, I was wondering, is there for storable commodity, is there a possibility for someone let's say, could someone just buy tons of commodity and store it and boost up the price?
They could try. So Jan's question is, could someone buy tons of the commodity, store it, and boost up the price? Okay.
Bill Gates will win the game eventually, right? He has the money.
Pardon me?
If Bill Gates or someone real rich will
Bill Gates, yeah.
win the game eventually.
So you'd advise Bill Gates to buy up all the wheat and store it?
Is there any regulation on this kind of thing?
There's no regulation on how much physical inventory you can hold, but it's expensive. And there's, as you know, there's a regulation in terms of how many futures contracts Bill Gates can buy or sell. And I told you about the Hunt brothers who tried to corner the silver market. So sure, there have been attempts to corner the market by buying up a large share of the physical commodity. But you know what? It usually backfires. Okay? Because there's a new crop or somebody else comes in and you're holding all this inventory and then the price goes down for some unknown reason, some political event. So it's expensive and risky. Julia. Futures contracts, yeah, I said Bill Gates, but he's talking about physical. Yeah, could Bill Gates buy an island? I think he probably owns some already. Okay. So could he take one of his islands, build a big storage tank, and fill it up with the world's crude oil? Yeah, sure he could, but then, we'd start pumping it somewhere else. And Alex?
Your example of the farmer going to Cargill and saying, I'm going to trade this store this week, is that over-the-counter trade?
Yes, it is. It's a forward contract. So Alex's question is that an over-the-counter trade? Yes, forward contract. We don't know. That price is not recorded. You and I can't find out what that is. And there is counterparty risk, right? If the elevator burns down, then the farmer in March doesn't know where to deliver his wheat, right? If the farmer goes off to Hawaii and doesn't come back, then Cargill doesn't get their wheat. So. Okay. Good questions. Now, let's look at kind of a specific example. And the reason I do this example is to try to get you thinking about factors that may influence price spreads, okay? We saw the price spread in oil. Well, I haven't shown it to you, but I told you it's $6 or $7. In crude oil over the next year. If you look at D16 minus D15, it's about $7. A few years ago, it was $2. Why is it 7 today when interest rates are low? And it was $2 a few years ago. These are questions that hopefully you can think about using this framework to understand these intertemporal prices. So what are all these lines here? Well, this is a story about heating oil. So heating oil, it comes from crude oil, and it's similar to jet fuel. Here's a barrel of crude. There's a barrel of crude oil, 42 gallons. Did you know that, Ann? You didn't? What? I'm just checking. So here's a barrel of crude oil. And, when they crack the barrel, when they process it, they get some gasoline that they sell to us, right? That's almost half of the crude oil, 47%. And they get some diesel fuel and heating oil. So those two are very similar. And they get some jet fuel, 10% jet fuel, some asphalt, a bunch of other products, okay? So here's heating oil. It sort of competes with diesel. And, it represents maybe 10% of production coming out of an oil refinery. Living in California, we don't see much heating oil, but it's a popular form of fuel in many parts of the country where there's cold winters for heating of homes and especially large buildings. So let's think about two seasons. We've got the summer season and the winter season. And you know that in the case of heating oil, the winter season is going to have a high demand relative to the summer because that's when we're heating the buildings and the homes. The supply might not be that much difference, but there could be a difference. But you know that these oil refineries tend to run continuously, so they're producing, so much heating oil every week. And we saw from the picture of the crude oil, there's some ability to increase the production of heating oil a little bit from cracking the barrel, but then that's going to come out of diesel fuel. So if diesel fuel prices are strong, we're not going to see a big surge in the production of heating oil. So that's kind of constant. And demand is much different in the summer than it is in the winter. So here's our summer period. Here's our summer period over here. This is our winter period. This is the supply in the summer. This is the supply in the winter. And you notice that the demand in the winter, dW, is much higher than the demand in the summer. All right, so that makes sense. So if there was no storage of heating oil, the price in the summer would be relatively low. We'd find an equilibrium in this market at $2.80. And the price in the winter would be high because demand is high. It's just like in the wheat market before we developed futures contracts. You had a low price of wheat at harvest time, then you had a really high price before the next harvest. So the price in the winter would be $2.90 because that's the equilibrium between supply and demand in the winter. So we'd have those two prices without any storage. But somebody like Paul comes along and looks at this and he says, well, that's a pretty big price spread. I wonder if I can arbitrage that. Okay? So he does some research and he finds that it costs 15 cents to store. Well, he's not going to build any storage facilities, are you? Because if it costs 15 cents to store, if you build a facility, your variable costs are 15 cents, and the spread you only expect to be 10, there's no point in storing, right? So if the storage costs are less than that typical spread, then there's incentive to build facilities. So let's say the storage costs are 4 cents. The storage costs are 4 cents. Then we're going to go ahead and build some storage. So over on the right-hand side, I've drawn what we call inventory supply and demand. So that's really the storage market. And that storage market is going to depend on what's happening over here and what's happening over here. So let's just focus on the summer. So in the summertime, if the price is $2.80, supply equals demand, there's no excess heating oil. However, if the price rises above $2.80, if the price in the summer is bid above $2.80, then supply is going to exceed demand. There's going to be more heating oil produced. So those guys that are turning the dials at the oil refineries are going to produce a little more heating oil and a little less diesel fuel maybe. And we're going to start moving up this supply curve, and we get to this price. Well, that's the supply and that's the demand. So we have some surplus heating oil. and we sell that to Paul because he's built this nice new facility. So he's happy to buy that at some price above 280, and he puts it into his tank. So we can draw, let's say Paul is Bill Gates, and he's the only guy with a facility. So we can draw the supply of inventory as being the horizontal distance between this supply and demand curve. So in other words, that supply curve is going to look something like that if I draw it over here. That's the supply of inventory. Okay? That's the same as SI. Why did I start it at $2.80? Well, at $2.80, there's no surplus heating oil for Paul to buy, so there is no inventory carried forward. If we move above 280, and we get to this point, well, that's this distance here, right? This distance is equal to this distance. And as the price increases, the difference between supply and demand gets larger, and so Paul's buying more and more heating oil. And so that's what he offers then in the wintertime. That's his supply curve. So that's the volume that goes into storage. Okay? And if there were no storage costs, then when we look in the winter, the difference between the demand and the supply is going to become important if the price is below 290, excuse me. If the price is at 290 in the wintertime, then demand equals supply, and there's no demand. Paul doesn't have any market, right? There's no demand for storage. But if that price falls below 290, then you see that there's a gap that opens up between demand and supply. At any price below 290, demand is greater than supply, and that's when they look for Mr. Gates and say, okay, we need some heating oil. Yes? Over here? Yeah, it's just the horizontal difference between these two curves. That's all. Yeah. So right here, there's no difference, right? It's zero, right? If we go up here, then this distance, shown in red, is equal to this distance, okay? And so on. The higher the price, the greater the distance. Yeah? Okay, I haven't got storage costs yet. You're just ahead of me. Just give me 1 second, and then you can ask your question, okay? So that's how we get the SI, and the DI comes from the distance between demand and supply at prices lower than 290. So if we come down here, then the demand is greater than supply, and that's equal to this distance over here, and that's a point on the DI curve. You see that? The demand for inventories is going to equal the difference between DW and SW at any given price. At 290, there is no demand for inventory because the market clears in the winter. If the price is lower than 290 in the winter, then there's going to be more demand for oil, heating oil, than there is supply in that time period, and that demand is going to be satisfied by Paul's company. Yeah?
I was wondering, like, why we're measuring the distance between the red market.
Why are we measuring the distance? Okay. What I'm trying to say is in the summertime, if the price is above the level that clears the market, then there's going to be more supply than there is demand. And where's that going to go? They're producing it at the oil refinery. Where's it going to go? It has to go into storage. They can't sell it on the market. If you produce this volume, you can't sell that volume in the market. You can only sell this volume. So this difference, where's it going to go? It's going to go to Paul. You can't sell it in the summertime, so he buys it and puts it in his storage tank. So that's why we're interested in that gap. In the wintertime, just the flip side, right? If the price is below 290, then we're seeing an increase in demand because the price is lower. But a lower price supply is going to be less, so that gap's opening up. So at a price lower than 290, the refineries can't meet demand. The refineries can't meet demand in the winter, so that demand turns to Paul and says, hey, you're sitting on all this heating oil. Why don't you put some of it onto the market? Which dotted line? This one? This wiggly one that's supposed to be straight? That's the same as this line here. I'm just showing you where it came from. It's the same thing, okay? And then we'd have over here, we'd have, probably not going to draw this very well, but we're going to have a line like this that's going to be the DI, demand for inventories. I didn't want to draw them on here because it's kind of messy. But we flip those over on the right-hand side, which is the market for inventories. We have the supply and demand for inventories. If there are no storage costs, if there are zero storage costs, if Paul's able to build a facility where it doesn't cost him anything, then the price in the winter is going to be the same as the price in the summer, isn't it? And he's going to be a nice guy, and he's going to take product off the market in the summer, put it on the market in the winter, and he's not going to ask for any payment. So we'd have the same price in the summer as the winter, right? It would be somewhere between $2.80 and $2.90. But that's not realistic. So there are going to be storage costs. Paul has some costs of building his facility. So those storage costs are going to shift the supply curve up, okay? So that's SI plus storage costs, which I said are 4 cents. So now we have a market where there's supply and demand in the summer, there's supply and demand in the winter, and there's inventory carried from the summer to the winter. His storage costs are 4 cents. So we have this equilibrium Q5. That's the volume of inventory. That's how much he takes off the market in the summer, how much he puts on the market in the winter. The price in the summer is going to be $2.83. The price in the winter is going to be $2.87. So Paul bids up the price in the summer, the $2.83. At $2.83, supply is greater than demand. It's equal to this distance. He holds it till the winter, then he sells it in the winter at a higher price, $2.87. He makes his 4 cents. He's happy. At $2.87 in the winter, demand is greater than supply in that time period, right? We're up here. So there's more demand than there is supply, and it just so happens that Paul happens to hold that quantity, that horizontal difference between the two, and he puts it on the market. So the storage market links the two time periods. The price difference between the two is going to depend on storage costs. And that's what I was saying earlier, right, when we looked at the wheat market. So the price spread is exactly equal to storage costs. If storage costs go up, that's going to affect the price in both time periods. Or if any of these curves shift, that's going to affect the price in these time periods. Just like if we go back to this slide, in the wheat market, I told you that was a snapshot, that was a picture of what's happening in the wheat market at one point in time. If there's news that comes into the market that says, well, the crop in China is going to be better than we expected, then this whole thing is going to shift down. Or if news comes into the market that says, you know, there's civil war in the Ukraine wheat supply is going to be affected, then this whole thing shifts up. So it's just like this heating oil example. So if we can continue with our heating oil example, we've established the fact that these markets are linked. They're linked through the storage activity. And I told you that if there's a shock to the market, then those equilibrium prices at 283, 287, they're going to change. So what could shock this market? Well, is anybody here trading heating oil in stock direct? Not yet? Okay, it's not cold enough. Once it starts to get cooler, keep your eyes on this market. So let's suppose that somebody comes out with a forecast that says, you know, the winter this year is going to be colder than we expected in the Northeast. We're going to have a cold winter. So what's that going to do to the demand for heating oil? Josh? It's going to go up. Exactly. It's going to push it up. Thank you. So there's a forecast, cold winter, that's going to push up this demand. Right? Because when we're sitting here now, this demand and supply is really an expectation, isn't it? Because we're in the summertime, we don't know exactly where that market's going to be, so it's going to push that demand up. And that's going to push into this market, because if the demand in the winter increases, that means the demand for inventories is going to increase, right? If we're going to have a cold winter, then we turn to our friend Paul and say, you better put some more oil in that facility of yours because we're going to need it come January and February. And how do we encourage him to do that? Right? The demand shifts right. So now we have a new equilibrium where the demand for inventories is this dashed line. Okay, it's moved up. Remember that the intercept started here. It's going to move up. That whole curve is going to move up. We have this new equilibrium, and the price is now going to be 289 in the winter. It's going to be 285 in the summer, right? So if Paul comes in and says, gee, cold winter, I'm going to put some more oil in my facility, he's got to bid the price up above 283. Otherwise, he's not going to get that oil. So he bids it above 283. He bids it up to 285. The volume in his facility goes up. He puts more oil in there. He's paying 285, and he turns around and sells it in the winter for 289. So we're sitting here in the summertime, and some dude forecasts a cold winter, and all of a sudden we're paying more for heating oil. Why is that? Because we have good Samaritans like Paul who's looking after those people that are going to be freezing in the winter. And he says, hey, I want some more oil, so he bids up the price. That affects us now in the summertime. And then he carries it. The volume of storage goes up, and the prices go up in both periods. So this type of shock happens every single day, right? Every single day. You're going to see these markets responding to news events like that. Okay, here's a kind of an interesting example of this arbitrage activity. And Jan's talking about Bill Gates. This has to do with firms that own these big super tankers that carry crude oil around the world. I don't know if Bill has any of these, but we talk about storage. We talk about the storage tanks down in Cushing, Oklahoma. The storage in the North Sea. But it's also the case that these large super tankers that carry oil from A to B, right? They carry oil from Venezuela to America or from the Middle East to China. Sometimes they're used as storage facilities, which is, I think, kind of interesting. And this happens when the market goes into contango. When the market goes into contango, you'll see people filling up these boats and basically parking them. So here's an example. This was in 2011. And this is the number of storage tankers in the U.S. Gulf. Okay? And these are just different types of tankers. The Suez Max is smaller than the VLCC. So these dots just show on June 10th there was one tanker. By July 29th there were 7 tankers sitting in the Gulf filled with crude oil, not going anywhere. What were they doing? They were trying to take advantage of a contango. So if we look on the right-hand side, the spread, the nearby spread, 95.33 minus 94.89 was 44 cents. And they were expecting that to increase. So if you buy oil, put it in your tanker, and then that futures curve steepens, then you can sell it and make a nice profit. But guess what? A month later, this nearby spread was 21 cents. Okay? So they were wrong. So that kind of answers your question, Jan. These firms are not fly-by-night. These are large companies. If you own a super tanker, you obviously know what you're doing. They thought the contango was going to steepen, and so they parked these tankers out in the Gulf, and actually the futures curve flattened. So they ended up not making a lot of money. And if we look, the next slide shows a different spread. It's the spread between Jan 12 and November 11. So that's a longer term spread, and that spread also went from 91 cents to 27 cents. Then last year, 2014, we had the same phenomena. So last year, so the earlier one was 2011. So this happens every once in a while when you get this contango showing up. So on the left-hand side, we see the price spread between spot price 97.70 and October delivery, which is 155. So that spread is about $2.85. Okay, that's a one-year spread. It's 285, and this shows the volume of oil held in storage on the water by these tankers. So some of these big tankers can hold over 3 million gallons. So we had over 42 million gallons. So we had probably 14, 15, maybe 16 tankers, different parts of the world that were hoping that this contango would improve. Earlier time period back in 2009, there was even a larger volume held. So this is a market where we talked about Paul building facilities. Here's a market where you have these vessels that are used for transporting oil, but if the market behaves in a certain way, all of a sudden they turn into storage facilities. Okay? So it's kind of unique. It's possible, I guess, we could use large ships to store more wheat or something like that, but I've never heard of an example of that happening. So here's the futures prices this morning. And if we look at D16, 51.37, and D15, 45.95, well, that spread is about $5.42, right? And the previous slide I showed you a year ago, the spread was $2.85, and all these tankers were starting to load up with oil and park offshore. Now that spread's even higher. So, it's not easy to get these data on offshore storage, but it suggests that maybe there's something happening right now in that market with the Contango at 542. Okay, Janet says it's time for the quiz. Please put away your books and your phones and any other Wi-Fi device.